Right. Well, the history of the Fed is that it's a very thankless position, right? It's not well compensated, and you're under the direct targeting of all the market participants. So it is a really thankless job. But if you listen to what the chairman is saying, he is telling you that he is going to continue the path of hiking rates. And when Mr. Powell came into office this year, he was lauded for actually being someone who's pragmatic, who thinks about market behavior. But we shouldn't just take that only in downside, in declines in the equity market. Remember, the equity market is still up year to date. Inflation's hitting their targets by almost every single measure out there. And so there is no reason to think that this short-term volatility over 1 week is going to derail the Fed's path.
But here's the question I've had about this volatility. I mean, we all know the Fed's been raising rates. We all know the economy's doing well, that there are price pressures. There's a slowdown in China. You know, we've got the whole litany of things going on right now. So why all of a sudden this spike in long yields that began last week that's caused this volatility this week? What changed all of a sudden?
Well, the front end of the curve in the 2 years has been pricing in the Fed hikes all year and really for the last 15 or so months. So it's not that the entire bond market was ignoring the Fed hikes. There is a dynamic that's been pointing to with the corporate tax code this year that pension plan contributions from corporate entities were deductible at last year's tax rate, which makes them inherently, for their pension plans, which have long tails in their liability stream, makes them buy longer duration assets. So if you put those contributions in prior to September 15th, they were deductible at last year's tax rate, which, as we all know, is significantly higher than the tax rate they see this year. So there has been that idea thrown around the market that perhaps that was indeed suppressing the back end of the curve.
All right.
As you've seen, since September 15th, rates have been up. But we did break through the critical level that we've been focused on here at DoubleLine on the 30-year long bond, where it finally broke through that 325 level, did it with authority, and that's really what really started setting off this repricing of risk assets. As the long bond woke up, the 10-year set new highs. Right now, as we're speaking, the 10-year is roughly at what was previously the high of the year. The long bond still is slightly above where it was before it broke that trend. So we continue to watch the long end of the curve, and it's repricing essentially on the growth prospects. The inflation is coming through, and the belief that the Fed will continue to hike absent some massive miss in the data. And so I think that's what's changed about the Powell Fed.